Welcome back, students. This is another video in the series on chapter 4. We're going to speak about depreciation. Now, what is depreciation? Depreciation is when you reduce the value of your assets. Now, assets are things you buy for your office and your factory, such as vehicles, machinery, tools, and equipment. Now, you need to decrease the value. For example, if you buy something like a car and it's worth 50,000 when you buy it, at the end of the financial year, it can't still be worth 50,000 as you use it in your business. So the amount it decreases by or with is called depreciation. Now, depreciation for a factory item is an actual MOH expense. Depreciation for an office item will be recorded in the profit or loss account or in the income statement. Now, when you want to calculate depreciation, you must first establish, are you calculating depreciation for the full financial year or for part of the financial year? If you're doing it for the full financial year, you must first establish the start and the end of the financial year. Then the next thing, what method are you going to use to calculate depreciation? Then establish the rate of depreciation, and then you need to read the contents. Now, the first method you're going to use to calculate depreciation is the straight line method, also known as the cost price method, and the fixed installment method. This is when you calculate depreciation on the cost price of the asset. Here I've got an example. Rate of depreciation on machinery at 20% per annum. Now, when they say per annum, that means you're calculating depreciation for the full financial year on the cost price of the asset for the financial year ended 31st. The cost price is 100,000. Financial year, because it ended on the 31st of December, that means it started on the 1st of January and ended in December. The rate is 20%. The method, cost price method. Now, depreciation is calculated. You take the cost price at 20%. Now, that 20,000 is the depreciation for the whole financial year as you're calculating it for the full financial year. If this is depreciation you're calculating for a factory item, then this will go to MOH. So MOH expensive. If it is an office item, then it will go to profit or loss account or the income statement. Now here it says rate of depreciation at 20% per annum. Now per annum means for the year, for the financial year ended 31st December. The machinery was purchased in June. Because you only bought it in June, you only have the asset for 7 months. So what do? You take the cost price, which is 200,000, times it by 20%. But if you're going to take it times 20%, you've got to take that amount divided by 12 and times it by 7, as you only have the asset for 7 months. If you are doing the books for 1 month, you will then take, in the first example, 20,000 divided by 12 to get the depreciation for 1 month. If you're doing the books for 2 months, you take 20,000 divided by 12 and times it by 2, as this is a depreciation for the full financial year. Now, the next method we're going to look at is the diminishing method, the reducing method, or the book value method. What does this entail? When depreciation is calculated by taking the cost price less accumulated depreciation. Now, what is accumulated depreciation? When you add depreciation, all the depreciation for the years since you've been writing off depreciation. In this example, rate of depreciation on machinery at 20% per annum using the diminishing method for the financial year ended 31st December 2012. So here it says you purchased the machinery in January 2012. That means you've had it for 1 full financial year in 2012, and this is now your 2nd financial year. The cost price is 100,000 accumulated is 20,000. That means you've written 20,000 depreciation. In example 1, you calculated depreciation on the cost price. In this example, you will calculate depreciation on the book value, which is 80,000. So it's 80,000 times 20%, and that's 16,000. If this was a factory item, this will be an actual MOH expense. If it was an office item, it will be recorded in profit or loss or income statement. The production unit method. Now, I'm going to use this example here, for example. Activity 15. The cost price is 235,600. Kitchen units to be produced over 10 years is 45,000. Kitchen units produced for this actual financial year, 6,400. Economic life is 10 years. Now, what this method means is when they use the production unit method, when they buy equipment or machinery to make the goods, they estimate how long they want the machine to last. Now, if you look at this example here that I'm referring to, they hope the machine will last for 10 years. In this 10 years, they hope to produce 45,000 units. The actual production for this financial year is 6,400. The cost price when they bought it was 235,600. So actual output of units produced will be 6,400. Estimated output is 45,000. Cost price is 235,600 divided by 1. The amount you get there will be known as the depreciation. So that covers depreciation and the 3 methods. In my next video, I'm going to be speaking about ledger accounts.